This is Josh Jalinski, the financial quarterback. Don't touch that dial.
We've been getting a lot of listener questions about required minimum distributions, or the dreaded RMD as it's called. If you make the mistake of ignoring RMDs, there are penalties involved. So today on the Financial Quarterback, I'll be explaining how RMDs work, how you can affect your retirement accounts with RMDs, and I'll give you some strategies to manage the RMD effectively. RMDs are required minimum distributions. It is the amount the federal government requires an individual to withdraw annually from their IRA or employer-sponsored retirement plans after reaching age 72. And if you're a certain age, it can even go as up to 75. Why do they exist? The goal is to encourage people to use their retirement savings during their lifetime, rather than using them as a Mitt Romney-sized tax shelter to transfer wealth to heirs. There were some news articles about Peter Thiel's IRA and Mitt Romney's mega IRA. Hey, the ultimate reason you got to take an RMD is because the government gave you a tax break. Your favorite uncle, Uncle Sam, gave you a big, beautiful tax break from 20 to 72, and they want their money back. And they don't want you to just tax the seed. They want you to tax that big, blossoming $1 million harvest if you're so fortunate. When do RMDs start? As of 2023, RMDs must begin when you turn 73. It was 70 and a half, then it was increased to 72. And it's set to increase again in 2033 to 75. Which accounts are subject to RMDs? Traditional IRAs, 401ks, 403bs, other employer-sponsored plans. I didn't mention Roth IRAs because Roth IRAs are generally not subject to RMDs. It's a benefit of the Roth. How is the RMD determined? The RMD is determined by the account balance as of the previous year's December 31st value and the account holder's life expectancy based on the IRS life expectancy table. And what that means is if you look at this table and let's say you have $1 million in an IRA, you look at the divisor on the table, and let's say that divisor is 27.4. You take your sum, $1 million, you divide that by 27.4, would be $36,496. That's generally about right for the first year you hit 73. Now, the IRS provides different life expectancy tables depending on your situation. Most people use the uniform lifetime table. If your spouse is 10 years younger than you and is the sole beneficiary of your IRA, you use a different table. And sometimes, little tip is don't assume that your financial institution knows your spouse is younger than you by 10 years. They don't, and they often make mistakes on this. So be careful. Penalties for not taking RMDs. A 50% excise tax. This is why it's so important to understand an RMD, because if you do not take your RMD, you will be taxed a 50% excise tax on the amount not distributed as required. Now, there are ways to get around this if you miss it, but you don't want to run afoul of this rule if at all possible. Example, if your RMD for a year was $36,496 on $1 million account, you would owe 50% on that $36,000 or $18,248. Let's make it smaller. If your RMD was $10K and you only withdrew $4K, so you would owe 50% on the $6,000. That's a $3,000 tax hit you didn't need to pay. It's like an idiot penalty. It applies to each year you fail to take the full RMD. It's an excise tax. It is on top of your regular income tax. So you not only pay income tax with that money, you also pay this excise tax. If you have multiple accounts subject to RMDs, the penalty applies to each account that didn't receive its required distribution. A pro tip, call up your custodian or your IRA company and ask them if they can set up automatic RMDs. Many institutions will do it, some do not. But realize it's your responsibility. It's not your financial advisor. It's not your accountant. They'll all blame you anyway. They'll say, love you, Josh. Love you, Jack. But you didn't do what you were supposed to do. Distributions don't offset. If you take too much out of one account and too little from another, they don't offset each other for penalty purposes if they are different types of accounts. So if you have a 401k and you have an IRA, you got to take an RMD from each one. However, you can do what's called IRA aggregation, where you do get to offset all of them, but you have to realize it has to be the same type of account. So you can't mix and match. You can't aggregate with a 403B and an IRA. That's one benefit of an IRA rollover, is you can generally aggregate from all IRA sources. But you can't aggregate when you have different types of accounts. The IRS may waive the penalty. They generally will pass waivers due to COVID or hardship, or sometimes even the stock market crashing. But they can also waive the penalty if you demonstrate that the shortfall in distributions was due to a reasonable error and you're taking steps to remedy the mistake right away.
Josh, how would one argue this? And have you seen it done before?
Oh, yeah. We've helped clients do it before. We're not giving tax advice or claiming to be your CPA, but in many cases, one of the catch-all rules is called custodial error. So that's another way to get out of it. Sometimes sending a letter of the facts and circumstances gets you out of it. IRS rules that RMDs must first be satisfied before any amounts can be converted to a Roth IRA. That's why it's best to do a Roth conversion before your RMDs are due. Attempting to convert RMDs directly can result in another tax, a 6% excise tax penalty, while the excess remains in the account on the amount that was supposed to be withdrawn as the RMD. So, if you run afoul of the RMD, bottom line, don't forget to take your RMDs. So some common mistakes on RMDs, other than forgetting to take them: miscalculating the amount, not accounting or aggregating all eligible accounts, missing deadlines. Remember, while it's typically December 31st, the first year's RMD can be delayed until April 1st of the following year when you turn 73. That's a little tricky piece of this rule. So my tip is just take an RMD every year. When you hit 73 and it's, so you don't, that April 1st rule is confusing. Now, if you worked a full-time job before you took it and you had higher income the prior year, that's when you would want to double up. And you take one by April 1st of the following year and then another by December 31st. But realize if you delay till April 1st of the following year, you then have two RMDs in that year, which may throw you up into a higher tax bracket. Another problem is not adjusting for major life changes, relying on old or dated information, trying to roll over RMDs. I want to be clear here. I had a client who just came to me this week. He said, "Dear listener friend," he said, "Josh, I realize I need you. I need your firm because I need a distribution phased advisor. I need somebody who begins with the end in mind. Too many of you are accumulation focused. You want to grow that 401k. You want to grow that IRA. And although that's critical, that's investment management. We believe in that. We have an investment committee that does that. However, you need a distribution plan so that you can spend all of your money without going broke, so you can literally enjoy your money. Let me give you an example and some lessons learned. An employee, we'll call him Tim, retires in or after the year he turns 72, and he wants to roll over his 401k funds to an IRA. Does Tim need to take an RMD before the funds are rolled over? Remember, RMDs normally don't need to start until April 1st, following the year you turn 73, or April 1st of the year for retirement when you are still working. That's called the still working exception. That April 1st is considered the RBD, or the employee's required beginning date. So if you don't know your required beginning date, if you don't know your RMD formula, if you don't know what you should do with the RMD once you get it, that's another tip. Don't just blindly take it out. Figure out, am I going to spend it? Am I going to save it? Am I going to give it away? We can help you with that. If the rollover takes place after the required beginning date, the RMD from the 401k must be taken before the rollover. According to Ian Berger of IRAHelp.com, common question is this: an employee retires in or after the year he turns 72 or 73 with the new rule and wants to roll over his or her 401k funds to an IRA. Question: does an RMD have to be taken before the funds are rolled over? What makes this tricky is that the required minimum distributions don't normally start until April 1st following the age 73rd year if you're using the still working exception. That April 1st date is considered your RBD. But if the 401k to IRA rollover takes place before the RBD, it would make sense that no RMD should be required before the rollover occurs. But as is the case with many IRA plan rules, what makes sense isn't always the correct answer. The correct answer is that the RMD from the 401k must be taken first, and only what's left can be rolled over. How can that be? Well, first, the IRA says that the first funds distributed in a year in which an RMD required are considered part of the RMD, the first dollars out rule. Second, the first year in which an RMD is required is not the year of the RBD, it's the year of retirement. That is the year before the year of the RBD. Third, RMDs can never be rolled over. So let's just say we have a guy named Carl. He turned 73 in 2023 and needs to take his first RMD. He has 3 accounts: $400K from a traditional IRA, $300K in a 401k from a previous employer, and $100K from a Roth IRA.
What was his mistake?
Because of his miscalculations, he under-distributed. The penalty would be 50% of the under-distributed amount. Plus, he took an unnecessary distribution from his Roth IRA and stopped the tax-free growth, which is why you do a Roth IRA. Sarah, age 75, has $500K in a traditional IRA at the end of the previous year. She's required to take her RMD by December 31st, 2023. She had a family emergency and forgot the deadline until 2 months later in February of 2024. What does Sarah owe? 50%, which is the penalty for the missed deadline and the missed RMD. Second, Sarah owes income tax on the distribution for the 2024 tax return. That late distribution does not count towards her 2024 RMD. She has to remember to take it out again by December 31st, 2024. What are some resolutions here? Number 1, immediately withdraw the missed RMD amount. So that's called a corrective distribution. Number 2, file the Form 5329 along with her tax return. Number 3, write a letter explaining why you missed the deadline, that it wasn't willful neglect, and request a waiver of the 50% penalty.
So what could Sarah do for herself before the 2024 deadline?
Well, she did the corrective distribution, number 1. Number 2, make sure she takes it for 2024 so it doesn't happen again. 3, make sure it's automatic. You know, a lot of these custodians used to send you reminders, and they're not really sending reminders as much. So call your custodian and make sure it's on autopilot. You could get a monthly check. A lot of people like to wait till December to take their RMD. I like that, but I would at least give yourself, take it every November. So if you don't get it by November, then you have a month to correct it. Also, you got to realize these people are getting older, some in age. Not 75, it's pretty young still. But we have people, sometimes they're 90 and they forget to take it. Like in an aging population, yeah, okay, Granny, you forgot to take your RMD. Bam, you get hit with a 50% penalty. I do know that from clients who failed to take it, they generally have not gotten, thrown the book at them. They've generally waived the 50% penalty. Now, remember strategies to manage RMDs and minimize their impact. Number 1, you got to start planning before you actually have to take the RMD. So if you are 40 or 50, you want to make sure you're maxing out your Roth 401k and Roth IRA so that this isn't as big of a problem. Consider cash value insurance, money in after-tax accounts, but still, A lot of you, your biggest tax deduction is your 401k. So you need to make sure you plan this wisely. If you have a 401k, 403b, TSP, what I call the alphabet soup of investing. Once you fulfill your RMD obligations, one of the benefits of converting additional funds from your IRA to Roth is that you will lessen the amount you will owe in future years. This strategy involves paying income tax on the amount converted, but can be very beneficial if you expect your tax rate to be higher in the future, or you wish to leave assets tax-free to your heirs, or if their tax bracket is high. To minimize taxes, make withdrawals from your traditional IRA or conversions to a Roth IRA in years when your income is lower. If there's a market downturn where the value of a stock drops and the taxable value of the investment goes down, a Roth conversion could be beneficial if you plan on keeping that investment over the longer term. So let's say you own 100K of a stock that drops 30% and is now valued at $70,000. By converting the stock position from a traditional IRA into a Roth IRA, you now pay tax on the $70,000 conversion. As a Roth IRA grows tax-free for you and your heirs, allowing you to take advantage of the potential stock recovery and long-term growth that a tax-free Roth IRA affords. Now, you want to make sure you keep track of all your accounts subject to RMDs. You want to make sure you calculate RMDs accurately each year across different accounts. Next, you want to set up automatic distributions wherever possible. And then you always want to double check your calculation and check with a financial advisor like our team. Referees are kind of like the IRS of football. They're going to pay attention to everything you're doing with your finances, and it's important you follow the rules. You don't want that yellow card that'll set your team or finances back. You don't want to be flagged with the 10-yard penalty. Talk to a financial advisor who knows these rules inside and out and can make sure you win the financial game.